number of Fed officials pointing to more rate hikes than at least thought a month ago, say. According to minutes from the central bank's latest policy meeting, investors certainly keeping a close eye on the path forward for the Fed, while DoubleLine founder and CEO Jeffrey Gundlach says stocks are in a protracted bear market. Yahoo Finance's executive editor Brian Sozzi got a chance to sit down with Gundlach in an exclusive interview yesterday, touching on several hot topics for markets and the economy.
The inflation outlook perhaps darkening from what was kind of pivoted to an investor's psyche, a state of relaxation. I think the stock market is in a protracted bear market. With interest rates having risen and now they're rising again, it's very negative for the stock market when you have rising interest rates against these valuations. A terminal Fed rate yesterday was up at 5.35. I'm skeptical that it's going to get there. I think that in spite of the fact that inflation is going to be reluctant to come down, I just think the shape of the yield curve is the best indicator of the forward economy. People are always asking me this question, how bad the recession is going to be. It doesn't matter. As long as we're going into recession, you have to have a certain degree of protection.
All right, a lot to digest there. Here with further insights is Andrew Patterson, Vanguard senior international economist. I don't know which of those things to pick up on, Andrew. So I'm just going to ask you this, and it harkens back to what we were talking about earlier in the show, which is that the market now sort of is in line with the Fed, right? And saying, yes, the Fed is going to raise by three more times in quarter point increments. Do you think that's the case, or do you think that the market is still sort of getting it wrong, as Gundlach seemed to imply?
So in terms of, concerns that Jeff was expressing there around, recession going forward as a result of the yield curve inversion, yes, our base case as well is still one of recession. We had believed it was likely to occur in the second half of 2023. Again, that remains our base case. As Jeff mentioned as well, how deep is the recession going to be? Very difficult to predict with precision. Any recession is going to be painful. So it's something that investors should be prepared for. Going forward in terms of Fed policy, we believed, we felt the Fed, had an opportunity to push back a little bit on the perceived dovish tone coming out of the 25 basis point rate hike. We think they have another opportunity this time around to push back on some of that sentiment there that may have been pushing financial markets a bit higher.
So that pushback that you're talking about potentially, does that come, for instance, perhaps tomorrow, even as soon as tomorrow when we get those PCE inflation data from the prior month kind of catching up with CPI? Just wondering, their next meeting is what, in March here, and expectations, we've seen the yield curve shift up rather dramatically, especially the belly of the curve. I'm just wondering, at what point do you think they push back, if at all?
So I think, they have an opportunity tomorrow. I believe there's 5 Fed speakers on tap tomorrow, in addition to the PCE report coming out. So a reasonably big day in terms of, macro outcomes. They'll have opportunities going forward, as you mentioned before, the meeting in March. In all likelihood, they will take that opportunity to push back a bit on this. Chair Powell mentioned at his last press conference, that they were prepared to change the summary of economic projections, the much discussed dot plot, and the macro fundamental expectations there, if they felt warranted. We've seen some stronger data prints coming in, whether it's CPI, we would expect PCE to follow suit there. Whether it's somewhat stronger GDP growth in Q4, although that was revised down a bit this time around. But the Fed is really paying attention to these. 1 month is not indicative of a trend, but it's certainly enough to draw the attention not only of financial markets, but of the Federal Reserve as well.
And Andrew, is there going to be a recession this year, or is it more in the distant future?
As I mentioned before, our base case is still for recession sometime in the second half of this year. Everyone talks about those long and variable lags. We believe in those as well. So we were thinking more second half of this year. A risk that we've been starting to talk about more recently, and again, this is a risk, is we're coming at a later landing where Fed policy maybe has to go a bit further than markets anticipate right now because of some lingering strength in labor markets. And that results in an eventual recession, or at least a protracted downturn with below trend growth, but that occurring, towards the latter half of this year, maybe even into early 2024. But again, our base case remains one of recession in the second half of 2023 for now.
So where do you see financial conditions going from here? There's been a lot of talk, and we kind of touched on this earlier, about the Fed, Jay Powell not really pushing back on some of the slight easing in financial conditions that's taken place. What do you think happens over the next few months?
Yeah, it's likely to be, as Jeff mentioned earlier, a protracted bear market for equities. In all likelihood, there's going to be some volatility going forward. Same can be said for fixed income markets. That said, given where yields are today, to a very large extent, bonds are back as a diversifier, as a source of income. But that doesn't mean it's not going to be choppy going forward. It is very unlikely to be smooth sailing. As those long and variable lags work their way through the economy and financial markets. But again, a well-balanced portfolio, we believe, is a great defense for most investors.
No assumptions regarding smooth sailing here right now. All right, thank you for that and your insights here, Andrew Patterson, Vanguard Senior International Economist.